Tuesday, November 22nd, 2022, Monaco 64, home of alternative economics and contrarian views. So yesterday I spoke about the liquidity problems in the treasury market, which is supposed to be the most marketable market out there. We know, of course, that the most marketable commodity is gold, and that's why it's money. So I wanted to have Rafi on because he mentioned my video yesterday in his weekend report. But more importantly, he talked about gold revaluation. He speculated on the possibility of Fort Knox being empty, what would happen to the United States. And Rafi keeps track of the silver supply situation. So I wanted to ask him about that as well. So Rafi, welcome to the channel and thanks for coming on.
Thanks for inviting me.
You're welcome. So maybe we could quickly go through the treasury situation, the liquidity. Maybe you want to give us your view on why it's so important to keep track of that.
Well, just in terms of the definition of money, right? If you go back to Karl Menger and what made him so unique as the founder of the Austrian school, this is before Mises came along, is that he defined money as, by definition, the most liquid, marketable commodity, which is what makes it a good store of value, which is what makes it a good intermediary, and all the other things that it does. So right now, the most liquid asset, I wouldn't call it a commodity, happens to be U.S. Treasuries, and the fact that it right now mimics that job of money means that it is the de facto money substitute of the world. So if liquidity is drying up in this market, that means that treasuries are no longer, or on the verge of not being, the most liquid commodity, and that's kind of liquid asset, that, place of a liquid commodity in the world. So then it won't act as money anymore. And then all this liquidity that goes back and forth in the treasury market, because you have to if you're going to make a large transaction, you have to park your money there first before you put it somewhere else. It's like the monetary hub of the world. But if it stops functioning that way, then all this money that's looking for a hub, all these money substitutes that are looking for a hub, are going to have to go to something else. And it's not going to be Bitcoin, it's going to be gold, because that is the most liquid commodity. It's just not functioning that way right now because the substitute is taking its place, but it's built on lies, so it can't last much longer. And if liquidity is drying up, then either the Fed has to re-inject liquidity or give up on the treasury market, or let rates rise to the market clearing price, which would increase liquidity naturally, which would probably be something like 20-25%. I don't know, some crazy number like that.
Yeah, the other thing as well, treasury bills, notes, and bonds, they're not just used to park funds, but also they're mainly accepted as collateral for a lot of other financial transactions, and mainly because people see it as safe, government-backed U.S. Treasury. They'd rather take that than cash, or yeah. So I wanted to go on to the situation in terms of gold revaluation, and I'm gonna share this screen here for a second. Let me just get it, just to show you, Rafi, and the viewers. This is from Thorsten Polleit, Dr. Polleit. I've had him on the channel a few times. He writes for the Mises.org Institute. I recommend you go and look there for his stuff. He also has a YouTube channel in German and in English. You might want to check it out. But he put this on LinkedIn yesterday. Central banks keep rebuilding their gold reserves. And he asks a question here, which is interesting. Do not put trust in the US dollar, euro, and co. So it's amazing how, if you look at where it starts picking up, it was right after the 2008 crisis, the central bank's reserves. I think the US has about 260 million ounces. This is in millions, so it's around 1.181 billion ounces that we've got.
Mhm.
Any views on that, Rafi? And maybe you could talk a little bit about Fort Knox and the gold revaluation, how it would be done by the central banks.
Mhm. Well, about that chart, it looks a little bit, I wouldn't say manipulated, but a little bit like it wants to show a certain kind of picture because it starts at 950 instead of
Yeah,
zero.
I agree.
So I don't know how much this is actually saying, because I can't see it in context, and I don't really know the numbers that the gold central banks had like in the 30s, 40s, whatever. I mean, maybe this is significant, maybe it's not, but in terms of percentage, let's say it's 1200, 900 versus 950 at the low. So like what, 30, 33%, something like that. Okay, fine. I'm not that impressed. But generally, I don't want central banks to have gold, because in the end, it doesn't really matter how much they have, because the point is not that we don't want them to have gold, but it's that we want money to be real again. And if they want to spend money, they should have to spend real money, and they should have to spend their gold rather than spend our money by inflating. Spend your own money, like buy whatever you want. Just don't spend my money doing it. That would be the point. In terms of Fort Knox, I don't really know what's going on in Fort Knox. I don't think anybody really knows. But when that will become relevant is is at a time when I'm trying to still work this out in my head. We had this video or this interview with the head central banker of the Netherlands, was it?
Yeah,
And him talking about revaluing gold to backstop the balance sheet because the Bank of the Netherlands is in negative equity, which it's losing money just like all central banks are because they bought a bunch of bonds and now they're marking down the value of those bonds. What do you think's going to happen? So I'm trying to work it out logically in my head, and I haven't finished the process yet, but maybe you can help me along here. So let's assume that the Dutch central bank revalues gold from, well, I'm just using standard numbers here because the euro and the dollar are pretty much at parity. So let's say in the Netherlands, gold is 750 euros an ounce. Fine. So then they revalue gold, let's say to 5,000 euros an ounce, right? To expand to balance their balance sheet, whatever, to make it look better. Then you have a situation where gold is going for 5,000 euros an ounce in the Netherlands, but nowhere else. So what happens then is people buy gold from anywhere else in the world and sell it in the Netherlands, and then gold flows to the Netherlands, and then people have all those euros. They convert them back into their own currencies to buy things in their own countries, and then their currencies go up, and their currencies go down, and the euro goes up, right? Or is
yeah. I think what would have to happen is like some kind of conference where the major countries. So for the Netherlands, it would be the ECB, and then the Fed, the Bank of Japan, the Bank of England, all the major banks in the world would sit down. Maybe the BIS would be involved. Not that I like these guys, but I'm just saying what they'd have to do. They'd have to decide on a rate for gold,
Yeah,
not
they'd
just
have to do it together because
yeah,
if only one of
together.
them does it, then the market will drag the rest of them to do
Yeah,
it all
that's
anyway.
right. Yeah, and it wouldn't be done by the market. I think you mentioned that it would be done by the central banks. They'd say we're ready to buy. Let's say you mentioned the level $30,000, but we don't really know where they would have to do this. But in order, I guess it's at a level to cover their balance sheets, maybe 100%, maybe 40 or 50%. In times of crises, like in 1980, I think Dan Oliver mentioned that the Fed's liabilities were covered over 100%. So
Yeah,
the
for a
Fed,
few days. Yeah, for a few days it was like that.
so I guess they'd sit down and say, we want to have gold, depending on how bad the crisis is, at 100% of all our liabilities, or 40 or 50. 40 has been a number that a proportion that's been used. So let's say it's $20,000 in euros or pounds. So what they'd say is that they're ready to sell gold at 21,000 and buy gold at 19,000. So they keep this
Mhm.
band. And how do they
Okay.
do that? Well, they just print a lot of money, and I suspect they would also tell their bullion bank partners to close all the paper shorts. That would help the price rise. And it's interesting because the BIS, I don't know if you saw recently, they reported that their gold swaps are almost down to zero, which means they're not really doing any paper trades.
Okay. So then we're basically saying if one central bank, if one of them falls over and says like we can't do this anymore, there's a run on our currency, we need to revalue gold, then the rest of them are going to have to come to a meeting and do it together if they want to maintain their monopoly on currency,
Yeah.
or the market's going to force it anyway. And in terms of first of all, I want to point out something very big just about the fact of this discussion, right? So if one central bank is going to admit that revaluing gold is even a possibility versus the currency, because their balance sheet is in negative equity, then that itself is an admission that the real money in the equation is gold, and the currency is really just a derivative of that. Because a central bank cannot bail itself out with its own unit of liability. It's a logical loop, and it doesn't work out practically. Like they're going to have to bail themselves out with gold, which is exactly what happened in 1933. That is what Roosevelt did. But before he was able to do that, he stole it all. This time, I don't think they can do that. He tried. It'll cost too much for him to actually do it. So you're talking about, let's say, we don't know what number they would have to revalue at 100%, 50%, 40%. So thinking about that logically, okay, let's say they come to a meeting and they have a big central bank meeting somewhere. And then, wait, hold on. I think someone's at my door. Just pause it for a second.
Yeah.
So let's assume that they pick a number at random, which is exactly what Roosevelt did when he said 35. They pick a number, let's say they want to do 40% backing gold on their balance sheets, and that they think that's enough. So that means by implication that the rest of the paper on their balance sheets is worth 60% of the rest of the value of the dollar, right? So all these bonds and everything that they have is going to be 60% versus 40% gold. But the question is the market going to believe that? Because if they keep selling bonds and they keep getting rid of the mortgage-backed securities, or there's defaults on debt, et cetera, and they have to keep inflating, then yeah, they won't be able to maintain 60% paper backing versus 40% gold backing. I don't know what the market's going to do or exactly how it's going to be tested, but any decision they make will have to be tested by the market to see if it's believable. It just so happens that $35 an ounce, where Roosevelt put it, was basically enough to devalue all the inflation from 1913 to 1933. It just happened to be the right number, or around there. What's going to be the right number now? It depends what happens to the bond market. I mean, if it collapses, they're going to have to go to 100%.
If you're looking to acquire precious metals, have a look at our description below this video. We've got 3 affiliates, 2 in North America, ITM Trading and Miles Franklin, and in the UK. We are affiliated with Gold Investments. All the details are below in the description. Thank you. Oh yeah, 100%. That's right. Because if you look at when the Fed started business, and I think it was early 1915, even though it was the Federal Reserve Act was 1913. It was mostly gold, the balance sheet, and some commercial paper like bills. I think Dan Oliver spoke about that, and gradually they started putting government debt in that balance sheet. Maybe can you just for fun, really, because hopefully it won't happen. Let's say if the Americans found out that Fort Knox was empty, what would happen? What do you think would happen economically and politically?
Well, okay. Well, first of all, uh, I would challenge your wish that hopefully it won't happen. Hopefully, it will happen, in my view. And we can disagree on this. That's fine. But I would rather the dollar collapse completely and then the rebuilding would be forced to happen from the bottom up, because if the dollar maintains some purchasing power, then they're going to maintain a kernel of power from which to grow again. I don't want that. I want everything. I want the real reset on our terms. And I know it's going to be rougher. But you know, I'm not in charge of that. You're not in charge of that. Whatever it is, we're not going to dictate whether Fort Knox has the gold or not. So whatever it is, and it's called, you know, in Judaism, this is called a tefillat shav, or a vain prayer, because you can't pray for something that already happened. It's whatever it is, it is.
I
If
agree with you,
Knox,
Rafi.
yeah.
I said I hope it doesn't happen, mainly because it's going to be very painful. But I agree with you. It's probably it's the tough medicine, so to speak.
Yeah, it's the best. It's the best medicine. So if it's empty, then there's going to be a complete run on the dollar, and the dollar would go to absolute zero. And then that's the situation where you would there where logically there would be no gold substitutes, because the dollar is still a gold substitute. But if it's not a gold substitute, then in that case, silver, going back to silver now, silver would need to come onto the market in monetary form, because silver is the natural gold substitute. It divides gold on a fair basis physically. Because if paper doesn't work, you need the actual metal. So the dollar would go to zero, and then the economy would redenominate itself in terms of gold and silver ounces, probably around a 15-to-1 ratio. And that's when we would have to help by distributing the money supply, which would be our job.
You mentioned as well that the United States could break down and collapse, and that the states would become independent.
Yeah, that's possible. I
Yeah,
don't know exactly what's going to happen. I'm not a political genius or analyst. I'm
yeah,
just guessing.
yeah. But
Yeah, I mean,
why I
there are relatively sound fiscally states. Florida, I think, is one of them. Doesn't even have an income tax. Nebraska, Wyoming, those kinds of states, and they would. I don't even think they would actually have to secede officially. Although they might. They would. You know, by all intents and purposes, have seceded anyway, because the federal government would be bankrupt and would have no way of enforcing anything, and because they couldn't pay for anything if Fort Knox is empty.
Yeah,
And
that's
then
why I
the
shared.
states would be left on their own.
Yeah, and that's why I shared this page here, because Texas built a bullion depository. I think it opened in 2018, so and that makes sense. If that were to happen, they want to have. I'm not sure how much gold Texas holds, but I think Kyle Bass advised Texas a few years ago to buy physical gold. The state of Texas, and he said, "Don't buy on COMEX, take delivery." So to wrap up, Rafi, could we just go over the silver situation on COMEX, and also maybe LBMA, if you're keeping track of that, what's going on with the supply?
Well, since silver started to climb a little a little bit, I think to $20, $21, the registered supply has kind of stayed stable. It hasn't moved much. It's still around 35.5 million ounces left. In the eligible supply and the total supply, the drains keep coming. So we don't know exactly who that is, who's doing that, who's taking their silver off of the storage there. And in terms of the ETFs, and mostly SLV, it hasn't added gold since the rally. Sorry, it hasn't added silver since the rally started. So that means that the paper traders are not really chasing SLV, and they're still off the back of the market. And this is coming from physical demand, because the premiums are still above 40%. I think they've come down a little bit, but they're still higher than they were in 2008. So we're still very, very high on physical demand here.
So usually when I finish my morning video, and this is like my morning video today, and we got Rafi, we look at the market. So Rafi, just wanted to run through the prices here. So it's 8:28 a.m. London time. So actually spot gold is up $8 this morning. It's at 17.45. Low's been 36 and the high is right around here. Silver is up 1.5% at 21.15. So up about 30 cents. The stock market, the futures are slightly lower, not much. It's pretty quiet. The currencies, they're a little stronger. Sterling is up 1/4%. The euro is up 1/3. The dollar is down 1/3 versus the yen, and the dollar is down 0.5% versus the yuan. We're gonna quickly check the ruble because a lot of my viewers like to look at the ruble. So the dollar is at around 61 versus the ruble, so pretty steady. And to finish off, Rafi, we'll look at the commodities. We got WTI crude up 1.25% at 81. Brent is up 1.2 as well at 88.30. High grade copper is up 1% at 361. And to finish off, we're going to look at the yield curve. The US Treasury 10-year is down 2.5 basis points at 380. The 2-year is down about 3 basis points at 450. So yeah, the curve is still heavily inverted. Any final thoughts for the viewers?
Final thoughts. Well, if it does happen that central banks decide to revalue gold, it's not going to be a process where it gradually rises. It's going to be it's going to be a skip, and that means you'll have lost your chance. So eventually, this is probably going to happen if they want to save themselves. So buy what you need beforehand. That's it.
Yeah, and the other thing you said is that if you wanted to buy a house or different assets, that will be the chance for you to divest from some of your gold and even maybe some of your silver, because like you said, it would happen like almost overnight. And if you wait too long, it will be maybe a little too late, right?
Yeah, well, my point was in the initial run on the currency, that's when the demand for gold and silver will be highest. So that's when you want to supply it when the demand is highest and you get the most for your buck, for your buck, for your ounce.
Yeah. And you have to think in relative terms, I think as well, not in terms of fiat currency, in terms of what you can buy with it, a house, some land, or if you like sailing a boat or whatever. So Rafi, thank you again. Have a great day. And for the viewers, if you enjoyed this video, make sure you hit the like button, share it, and subscribe to the channel if you haven't. Thank you. Bye.
Bye.